Hi, I'm Jim and I was retired. Boldin is getting better. Now, I'm an early adopter of Boldin and I just renewed for another year. Now, as an early adopter, I pay less than $120 a year, but I still think $10 a month is a great deal for financial planning in a box. In this week's video, I'll show you a beta view of some functions to set rate assumptions. I think Boldin beta rates a look. Pun intended. Stay tuned. Now, back in 2015, when I was retired and forced into an early retirement, I began looking for a TurboTax of financial planning, a product that was reasonably priced for a DIY retiree that I could use to project and plan for a smooth retirement. Now, Steve Chen's new retirement seemed like the product, so I signed up. In 2019, I paid for the annual fee for New Retirement's PlannerPlus, and I thought of it more of as a Kickstarter contribution to a project that I would hope would succeed. Back then, spousal Social Security was still evolving as something that they could plug in to the product. But I continued to renew as the product kept improving. Now, I first did this review in 2021, and I called New Retirement Financial Planning in a Box. And then just a few months ago, I shared this video to say that Boldin is better except for the name. I kind of liked the New Retirement name originally. I should note that I'm not receiving any payment from Boldin, so you're getting a DIY retiree's advice. Before I go any further, though, will you please take a moment to like, share, and subscribe to this channel if you like insights from a DIY retiree. Now, I've masked my overview page to hide the totals, but here's how you access the beta functions if you have signed up to participate in the beta features. And I'll put some links below to get to that. Once you click on that rate assumptions, you go to inflation and appreciation and click that down arrow and then read about the new beta rate options. As explained here, the rate options include a default based on historical data, or you can enter a custom rate, which then becomes your average. And the third option is the current option, where you can enter your own optimistic and pessimistic numbers, which then mathematically become and give you an average. The default ranges for optimistic and pessimistic ranges are 20% higher and 20% lower than the historical average rate. So for instance, if you use a historical average for an investment return that is 6%, the optimistic rate would be 7.2%, and the pessimistic rate would be 4.8%. But note that the inflation figures work in the opposite directions. These are the default averages for general inflation and medical inflation, for instance. The default average for general inflation is 2.54%, and for medical inflation, it's 3.36%. Now, I want to use a custom inflation rate of 3%. So the optimistic inflation rate would be 2.4%, and the pessimistic rate would be 3.6. But what if I wanted to set a lower optimistic rate and a higher pessimistic rate? Suppose I wanted to use an optimistic rate of 1.75%, remember those days, and a pessimistic rate of 4.25% to get to my average rate of 3%. Then I might want to continue to use the current method of setting your average rate of 3%. But it might be easier and more intuitive if you just use a custom 5% for medical inflation, for instance, and have Boldin set the optimistic and pessimistic rates on their default formula. Now here is the Boldin historical averages for Social Security cost of living adjustments, and this has caused some controversy in the past. But if you use the historical average of 2.54% for the Social Security COLA, then the optimistic is going to be 4.03%, and the pessimistic rate is going to be 3.05%. And again, if you're in a pessimistic outlook for your scenario and you're considering higher inflation, you should know that it triggers higher COLAs too. If you have assumptions about housing appreciation with a historical average of 4.4%, it will set an optimistic rate of 5.28% and a pessimistic rate of 3.52%. Again, this is their historical optimistic and pessimistic. And again, these are 20% above and below their historical averages. You can continue to set your own optimistic and pessimistic rates for investment returns. For this account, for instance, I've used an optimistic rate of 9% and a pessimistic rate of 4% to get me to an average of 6.5%. You can also use the default optimistic and pessimistic rates for investments based on the asset allocations that you have in the account. For instance, if you're aggressive, you can set the average at 10.25%. And if you're conservative, you can set it at a 5.92%. Again, these are based on historical averages. When you use these rates of return assumptions, though, you have to remember where they're coming from. And these are the ranges that they have. And frankly, while I am shifting to a 70-30 equity mix, I'm not really going to plan for an average of more than 8% on my investment returns, especially with many investment professionals warning that the U.S. markets could be in for lower returns in the decades ahead. Now, I'm going to share a link to this recent Vanguard Capital Markets Model forecast, which came out on February 21st, 2025, and it includes 10-year and 30-year outlooks for various asset classes. And you can shift between a graphic, between table and chart. Now, but notice when you switch between chart and tables, you do get some differences. This is the U.S. equities projections to return from 4.7% to 6.7% over the next 30 years. But when you look at the table format of those numbers, the 25th percentile is 4.6% and the 75th percentile is 6.8%. So you have to think about which numbers you're going to use and whether you're going to enter them in the current format of pessimistic and optimistic numbers, or aim for this custom average. Now, you can also get much more conservative if you use Vanguard's range for the next 10 years. U.S. equity is expected to range from 2.9% to 4.9% over the coming decade. I'm not sure we're going to get there. Vanguard seems a little too conservative, but they're in line with several other major investment outlook firms. And I'm not sure what numbers to use. I'd rather play it very careful, use the 30-year numbers, but be conservative. I'm not going to use the Boldin plugins of historical averages. I would rather put in my own numbers in either the custom or the current optimistic, pessimistic range numbers. Now, I'll conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.